Is the stock market about to crash? Today we're diving deep into some seriously alarming signals that have legendary investors like Michael Burry, the guy from The Big Short, raising the red flag. We'll look at why he thinks AI is the new bubble and what you can do to protect your money. Let's start with a classic, the Warren Buffett indicator. It's simple. It compares the total value of the US stock market to the country's economic output, or GDP. Think of it like a price-to-sales ratio for the entire country. When the market's value is much higher than the GDP, it's a sign that stocks might be overvalued. The historical average for this indicator is around 100%. Before the dot-com bubble burst, it hit 141%. Before the 2008 financial crisis, it was 110%. Right now, it's sitting at a staggering 190%. That's not just high, it's the highest it's been since the peak of the dot-com bubble. This tells us one thing: the market is historically expensive, and investors are betting on some truly heroic future growth to justify these prices. But that's just one piece of the puzzle. Let's look at another metric, the Shiller pay ratio, created by Nobel Prize winner Robert Shiller. This one measures the price of the S&P 500 relative to its average earnings over the last 10 years. Adjusted for inflation, it's a way to smooth out the short-term ups and downs and get a clearer picture of long-term value. The historical average for the Shiller pay is about 17. At the peak of the dot-com mania, it soared to 44. Before the 1929 crash, it was 31. And today, we're at 41. That is the second highest reading ever recorded in history. What does this mean in plain English? It means that right now, investors are willing to pay for 41 years worth of average earnings to own a piece of the S&P 500. Why on earth would they do that? One simple acronym, AI. The market is banking on artificial intelligence to generate massive, unprecedented growth. This brings us to Michael Burry's core argument. He sees today's market looking eerily similar to 1999, right before the tech bubble popped. The market's enthusiasm is being driven by a small handful of superstar stocks. Back then, it was the four horsemen of tech. Today, it's the Magnificent Seven: Nvidia, Apple, Microsoft, Tesla, Meta, Amazon, and Google. These 7 companies have attracted enormous amounts of investor money, and they now dominate the S&P 500. Their perceived growth potential, largely fueled by the AI narrative, is what's propping up the entire market. Everyone is convinced these giants will keep growing at an incredible pace, forever. But here's the catch, and it's a big one. Burry points out a dangerous disconnect. While expectations are soaring into the stratosphere, the underlying business fundamentals are starting to show cracks. For example, the growth in cloud computing, a key revenue driver for many of these giants, is actually slowing down. The costs to run these massive data centers are rising, and building and training these sophisticated AI models, it's incredibly expensive, costing billions of dollars. Most importantly, the path to turning all this AI hype into real, tangible, profitable products that people will pay for is still very uncertain. So you have this situation where expectations are rising every day, but the fundamental business reality isn't keeping up. This is the classic recipe for a bubble. It's exactly what happened in 1999. Investors got so caught up in the story of the new economy that they forgot to ask if the companies could actually make money. When the profits didn't materialize, the whole house of cards came crashing down. Burry is warning that we're seeing the same pattern repeat itself with AI. The narrative is powerful, but the profits have yet to prove themselves at the scale the market is pricing in. So, does all this mean the market is guaranteed to crash tomorrow? Not necessarily. These indicators, the Buffett indicator, the Shiller pay, the synthetic growth from AI hype, they don't come with a calendar. They don't tell us when a crash will happen. What they do tell us, with flashing red lights, is that valuations are at insane, historical highs. Investor expectations are completely unrealistic. And for today's prices to make any sense, company earnings, especially from AI, need to rise dramatically and quickly. If these AI-focused companies fail to deliver real, scalable profits, then a price correction is not just possible, it's inevitable. The market can't defy gravity forever. But nobody, not Michael Burry, not Warren Buffett, and certainly not me, can tell you the exact timing. It could be next week, next year, or even a few years from now. Bubbles can last a lot longer than anyone thinks. So what should a smart investor do when the market seems to have lost its mind? The answer lies in the Warren Buffett playbook. You go bottom up, not top down. Buffett has famously said he never tries to predict the market. He doesn't ask, is the market cheap or expensive right now? That's a guessing game. Instead, he focuses on individual businesses and asks a series of simple, powerful questions. First, do I actually understand this business and how it makes money? Second, does it have a durable competitive advantage, what he calls a moat, that protects it from competitors? Third, is the management team honest and competent, working for the shareholders? And finally, is the price I'm paying fair, and does it give me a margin of safety? The margin of safety is crucial. It means buying a great business at a price so reasonable that even if things go wrong, you're less likely to lose money, even in wildly overvalued markets like today. Disciplined investors say it's still possible to find good opportunities. Investing expert Phil Town notes that even if you only find one great company at a fair price all year, that's a huge win. The key is to stay disciplined, do your own homework, and resist the temptation to chase the hype. Don't buy stock just because it's going up or because everyone is talking about AI. Buy it because you understand the business and believe in its long-term value. Let's wrap this all up. Michael Burry believes we are in the middle of a massive AI bubble. The market is more expensive than at almost any other point in history, driven by sky-high expectations for a handful of tech giants. The only question left is this: can the profits from AI grow fast enough and large enough to justify the hype? Or are we watching the next big short unfold in slow motion? Only time will tell. But by staying disciplined, focusing on quality businesses, and demanding a margin of safety, you can navigate these uncertain times with confidence. Don't get swept up in the mania. Be a business owner, not a speculator. Thanks so much for watching. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the markets. Let me know your thoughts in the comments below. Are we in a bubble? See you next time.